Retiring with dividends is a great way to go about it, because instead of being dependent on whatever valuation the market is currently giving you for your portfolio, say you're invested in an S&P 500 index fund or just a bunch of growth stocks like Nvidia and Berkshire Hathaway, again, great companies, great returns, not going to deny that, but the market is inevitably volatile. And so there are going to be times when those stocks are going to crash. And if you have to sell them at that time to pay for living expenses, which you inevitably will if you're retired, you may end up shortchanging your retirement, especially if the market goes to a prolonged bear period. Whereas if you are independent of what the market is offering you for your holdings, and instead you're just living off the cash flow from the dividends, which generally are much more consistent than stock prices, you're not really going to have to care too much. You're not going to be beholden to Mr. Market's moods, and instead can just live off of the cash flow of your dividends. This helps you sleep better at night, helps you plan better for retirement, helps you to live your best life without having to worry about what's the market going to do tomorrow. So with that in mind, I'm going to share 5 stocks that if I could only retire with 5 stocks and I was going to live off of dividends, these are the 5 I would buy. Now, obviously, I wouldn't just own 5 probably, but this hopefully can give you a better idea of some good stocks, how to frame your retirement portfolio if you're thinking about dividends. Before I get into these 5 stocks, so if you give this video a like, help me grow my channel by growing the distribution of this video. Thank you so much. Greatly appreciate it. Okay, now what is the first one? Well, the first investment I'd buy if I could only buy 5 and I was looking to live off of dividends would be the Schwab US Dividend Equity ETF. I've covered this in previous videos on my channel. It's ticker symbol SCHD, but the reasons I like it are simple. First, it has a 0.06% expense ratio. That's an extremely low expense ratio. And in fact, SCHD is so well diversified, it has over 100 individual blue chip stock holdings that if it's 3.5% dividend yield, which is not great, but is still really good compared to the S&P 500, if that's enough to meet your living expenses, I'd say just hold that and call it a day, because it's so well diversified, it's simple, it's cheap on an expense ratio basis. Its dividend growth rate has been over 10% on an annualized basis for the past decade. Moving forward, it'll probably be a little bit slower, but it'll still probably be in the high single digits. And so I think that SCHD is a great pick for in terms of getting decent dividend income, very well diversified portfolio with exposure to a lot of different sectors, and you're getting that strong dividend growth that will help protect and even grow your purchasing power relative to inflation. Now, another ETF that I think complements SCHD quite well is the JP Morgan NASDAQ Equity Premium Income ETF. It's ticker symbol JEPQ. And why do I think it's a good diversifier for SCHD? Well, 2 big reasons. One is SCHD, again, the yield is a little on the low side, 3.5% if you're looking to live off of dividend income. And so JPQ, they sell options, sell calls against their underlying holdings, and they do them monthly. And so those monthly premiums they distribute to shareholders via dividend. And so that turns out to be expected moving forward over 9%. So if you average these 2 together, you're probably going to get an average 6.5% yield on your portfolio if you had 50% of each of these. And JPQ has 50% of its underlying holdings invested in mega cap technology stocks, which SHD largely lacks because it looks for higher yielding dividend growth powerhouses, and mega cap tech stocks generally don't pay much in the way of dividends, and many of them don't even pay dividends at all. And so when you combine these 2 portfolios, you get a well diversified portfolio, you get a good yield, and SCHD still makes sure that your income stream is growing at a pretty brisk pace. So I think those 2 are a great place to start. Now, both of these combined, though, they still lack exposure to some other key high-yield sectors like the business development company sector, the REIT sector, and the midstream/infrastructure sectors. And so I'm going to share 3 high-yield stocks in those sectors that would help to round out this portfolio nicely. So one of them is not going to surprise you. I talk about them a lot in my videos because I like it so much, is Enterprise Products Partners. It's a midstream NLP. It does issue a K1, so if that's a problem for you, maybe look into an alternative like Enbridge, which issues a 1099, or simply an MLP ETF like MLPA, which has a fairly low expense ratio and has a similar yield as EPD, and in fact, it has a large position in EPD within it. So, if you don't mind the expense ratio, you don't want the K1, that's where I would probably go. But EPD is great, has an A- credit rating, very well covered distribution, pays out over 7% yield. Been growing its distribution about a 5% annualized rate, so it should beat inflation moving forward. It's got a well-diversified portfolio. Insiders own about a third of the equity. What's not to like about that one? It's probably the single best income stock for a retiree that I can think of right now. Okay, another one that I like a lot is WP Carey, and this is a real estate investment trust. It's well-diversified, increasingly focused on industrial and warehouse real estate, but it also has a lot of retail. It also has some storage properties. And so it's pretty well diversified REIT, has a BBB plus credit rating, which strong balance sheet there, has a dividend yield of over 6%. That's very well covered by cash flow. It plans to grow its dividend moving forward in line with cash flow growth, and it should be growing its cash flow at about a 4 to 5% annualized rate moving forward due to a combination of retained cash flow that it reinvests, opportunistically issued equity, as well as it has some non-core investments it plans to sell in the coming years, and it can reinvest at a positive spread into triple net lease properties. It also has rent escalators, contractual, that both some of them are fixed, but over 50% of them are linked to inflation. And so if inflation were to re-spike higher, its organic growth would be higher, but if inflation falls, then interest rates will fall and it can refinance debt at lower rates, which would also provide a tailwind. So it's well diversified, it's well insulated against different economic environments. Its triple net lease business model is very defensive. It's held up remarkably well in past recessions. And so WPC is one that I would be able to count on pretty well through thick and thin to provide me that nice, attractive dividend yield that should also grow at an inflation beating rate moving forward. Okay, then my third and final stock that I like, the business development company one, is Morgan Stanley Direct Lending. There are others I like too, but this one's probably the best all-around risk reward for me right now. It has a 10% dividend yield that's well covered by earnings, has a solid balance sheet. It invests almost entirely in first lien senior secured loans. And so again, well diversified across different sectors and counterparties. Morgan Stanley's the external manager, has done a good job with underwriting and a good track record for the fund when it was private before it recently went public. Very low non-accruals. Morgan Stanley also owns over 10% of MSDL's equity, so there's good alignment there. It has a low fee structure as well, one of the lowest among external managed BDCs today. So when you add all that up, you get these 5 holdings, you get a really high yield, high single-digit yield. You get dividend growth, you get defensiveness, you get solid balance sheets, and likely a rich and rewarding retirement, especially if you overweight SCHG and JPQ. You get that really broad diversification with blue chips. You can complement with those 3 stocks that I just mentioned to further round out the portfolio and boost the yield and the growth. So hopefully this was helpful for you. If it was, please subscribe to my channel. Make sure you give the video a like and let me know in the comments below what other investments you like for a retirement dividend income portfolio. Thank you very much. Have a great day.